Hello, my name is Ben. Today we're going to share about 4 things. But before we get into that, I'd like to give a recap of what we've covered so far. We've looked at the introduction to trading, online trading. We've talked about the basics of trading, different markets, when to trade the markets, when not to trade the markets. We've looked at the 4 sessions in Forex trading, the 4 sessions, major sessions of trading. We've also looked at in detail what margin trading is all about, how to open a broker account, how to configure your charts, how to analyze and how to enter a trade at basic levels. Remember, what we are sharing here is basically an eye-opener, to give you a preview of what is expected of you when you join the academy, because the academy is very much detailed. I'd like to reiterate that you can't learn everything. You can't get all the info as far as trading is concerned by you following our videos. We appreciate your time, taking time to learn about the markets, but this is just an eye-opener. It's just a preview of what is expected of you or expected of us to offer to you as one of us as you join the academy. So this is just an eye-opener. And so today we are going deeper into our lessons. We're going to cover, we've started looking at how charts really look like, how you position yourself in the market, and how the market will be able to give you an opportunity to buy, an opportunity to sell. I think the previous lesson we looked at candlestick anatomy, where you were able to see red sell candles, blue or green buy candles, and where to enter the trades as a buy or a sell, when to do pending orders as far as buy stop, sell stop, buy limit, sell limit is concerned. We've all covered them so far. And so today we are going deeper into the markets. We'd like to look at in detail what retail trading is all about and the direction of the market. So in what we'd like to share today is about introduction to market structure. What is the structure of the market? Because for you to buy, you need to know what is the direction of the market. Market structure is just another word to say the direction of the market. What direction is the market taking today or this time? And so that you can position yourself either to buy or to sell. So we're going to look at market structure. Remember, it's just an introduction because we can't cover everything as far as trading is concerned in one video. So this is just a preview so that you can get to see how interesting and how beautiful the concept of trading is all about. So let's dive in and get to our lesson of the day today. So we'll be looking at retail trading, as I've already mentioned. We'll look at, when we talk about the market structure, we are looking at the direction of the market. So in other words, we'll be looking at the trend. What is the direction of the trend? And how do you trade in the direction of the trend? Because in trading, we say the trend is your friend. Okay? And we'll be able to know what that is all about. The trend is your friend, when to trade and when not to trade the markets. So we will be looking at, we'll be using this website. I think this is just an introduction. There's a website that we use for chatting. I know by now you know the difference between chatting and chatting. Okay, so we use a website called tradingview.com, as you can see right here, tradingview.com. This is the website that we use to be able to look at the charts. We don't trade on this website. We just use this website to be able to know, how charts look like, because it gives us a broad view of the market, a bigger view of the market. And so let's dive in and see what this is all about. Retail trading. Before now we go into the charts right away, I'd like us to remember that I think it was in our first lesson, we learned about the players of the market. Who are the people who buy and sell on the market? And among the things we mentioned, we talked about us, me and you as an individual, we are called retail traders because we are the smallest number in terms of amounts of people who are trading or trading volume in terms of money. We are the retail traders because we trade through a Forex broker. Okay, we have the big players that already play big in the market directly on the ECN or in the electronics communications network. But then for us who trade through a Forex broker as retail traders, we only account for 20% of the entire Forex population. So with that, it means that for us to be in profit, we need to play in the direction of the trend, in the direction of the big players who are already in the market, the big players, the big boys, the big girls who are already in the market doing big moves. We need to trade in their direction. So just to remind you that we are retail traders, so we can't really force the market. We can't really determine the direction of the market. We can't really make the market move in big volumes or with much liquidity, because retail traders, we trade with very low liquidity. And so for the market to make bigger moves, we expect that there are bigger players in the market, and those bigger players are the ones that we follow. They actually determine the trend, where the direction of the market, well, it will go. Will it go up? Will it go down? Or will it be sideways? Will it be a consolidation, a ranging market? So we'll be looking at that now, basically as just an introduction, that market structure is all about the direction of the market. How is the market structured? How is it configured? Is it moving up? Is it moving down? So we would like to go into that. And so as you can see on your screen, we're looking at the Euro USD, the Euro versus the dollar, okay, on the daily time frame. We won't be doing much of changing the time frames, because this again is just a preview. It's just an overview of what you will be getting when you get started with us in the Academy at Premier Blockchain Hub. So this market that is in front of you now is the Euro USD, and currently, based on where we are now, the market is going up. So the direction is upward movement. The market is going up. It's not coming down, it's going up, it's moving up, down, like that, going up. Now, that series of going up, down, but generally in the direction of upward move, we call those moves, like if you were to begin here, just like to, so that we can go together, I like to make the moves with you, so that we move in the same direction, that the market is making up, down, down, like that. We call these up, down. Technically, we call them higher highs and higher lows. So this will be your higher high. Okay, when you begin from here, this is a low, then this is a high, this is a higher low, this is a higher high, higher low, higher high, like that. So low, high, higher low, higher high, higher low, higher high, going up and up like that. So we have a series of higher highs and higher lows. When the market is making such moves, a series of higher highs and higher lows, then we call that an uptrend. That the market is moving up, coming down, moving up, coming down, but generally the market is going upward. So this is a high, higher low, higher high, higher low, higher high, higher low, okay? So we are making a series of higher highs and higher lows, and as you've seen, we are going up. Why is it called high? Because it's higher than below where it started. So this is high because it's higher than the starting point. And then this is a higher low. It is a low, but it's not lower than the low, okay? So we have a market here. I'd like you to note something. The market has started here, assumably. We have a high right here, okay? Then we have a higher low. It is low, but it's higher than this low here. So we call that a higher low. It's a low that is higher than the previous low. So we call that a higher low, okay? And then from there we go to a higher high. Why? Because it's higher than the previous high. Higher than the previous high, it becomes a higher high, okay? Then from there we go to a higher low. Why? Because it's low, yes, but it's low, it's higher than the previous low. So high, higher low, higher high, higher low, higher high, like that. So it becomes like a song. You make a series of higher highs and higher lows. And when now the higher low is broken, most likely that the trend is about to change. So the trend in Forex is basically the direction of the market. So you will hear this is an uptrend or this is a downtrend. If it's an uptrend, we call it a bullish market. Remember from the previous lessons. So when the market is moving up, the direction of the market is up, is making a series of higher highs and higher lows. And in that case, the market is bullish or the direction is upward. So we call that a bullish market. And as a tip, in a bullish market, we are only looking to buy. Remember, it is the big players that are moving the market higher. So you don't want to trade in the direction that is against the trend. So we say that trend is your friend. Okay? So if the trend is going up, follow your friend, because that trend, the direction of the trend is basically what is going to help you to stay winning on the market. You don't want to keep losing on the market because you don't want to trade in the direction against the trend. So this is a series of higher highs and higher lows. The market is upward. The direction of the trend is upward. The movement, or rather the market structure, in this case, it is a bullish market structure. So I hope that is very clear, that in an upward movement, in an upward trend, you want to trade in the direction of the market, which is buying. And so that is called a bullish market. We're making a series of higher highs and higher lows. I hope that is very, very clear, because now we want to look at when the market is going down, what does it form? How does it look like as a form of market structure? So we're now going to look at, from here, let's still keep looking at the euro versus the US dollar, in the direction in which, the direction of the market currently, as you can see, is that the market is moving down. It's going down. It's no longer going up. Okay, it has changed direction. It has switched direction, and the market is now going down. When it's going down, what happens here is that the market will be moving, making a series of, you're coming from high, you go to a higher low, okay? You go to another higher low like that, okay? We go down. Let's draw them before we begin calling them what they are. So when you're moving from up going down, this is what you'll be doing. Basically, what you'll be doing is that you're moving from up going down, go up, down, up, down, up, down like that, up, down like that. So when you do that, what we call these moves in the market. This is a high, a higher low, a lower high, lower low, lower high, lower low, lower high, lower low. Remember, in this case now we are making a series of low, lower high, lower low, lower high, lower low. Let's look at them now keenly. Okay, let's go back to the charts. So this is a high. We've made a low. Why is it a low? Because it is lower than where the market is coming from. Okay, the market is coming from here, high. It has made a low in the market. And then this low, we now have a lower high. It is low, it is a lower high. Why? Because it's low still, because it is not higher than the previous point where the market started from. So we have a low, lower high, okay? It is low, but it's not, it's a bit higher than the previous low, and it is lower than the previous high where the market came from. So low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, like that. When the direction is, when the market is making such moves, you want to be selling. The direction of the trend is downward. The market is going down, 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 down. You want to trade in the direction of the trend. Why? Because the trend is your friend, because the big players of the market are making the markets to move lower. So you don't want to trade against the trend. You don't want to take trades in the direction that is going against the trend. We have so many wishful traders who would say that the market is so low, so let's now begin buying, because what goes down, what goes up comes down. How do they normally say it? What goes around comes around, right? But then in this case now, the market is the market. This has nothing to do with what goes around comes around, or what comes around goes around. No, the market is the market. The big players will determine where the market, how low the market will go. You and I as a retail trader, we don't determine how lower or how higher the market will go. You can't say this market is so low, it has gone down too much, now we need to begin buying. No, you need to trade in the direction of the trend. You need to take trades in the direction of where the big players are moving the market. Don't wish that the market has gone down so low, so let's now begin buying so that you can become lucky and earn more while others are waiting for the trend to form. So we do not count on luck. As a technical trader, you look at the charts and the charts speak to you and you determine the move based on where the direction of the market is going. So market structure is almost 90% of what will determine your success in Forex as far as technical analysis is concerned. The aspect of trading is, it's diverse. We have the, what you already mentioned, the technicals, the fundamentals, the sentiment. Apart from that type of analysis, we have another way of trading the market, which we call it market psychology, that we'll be looking at in an entire lesson. We'll take one full lesson to look at market psychology. So you need to be at peace with yourself when you trade. We don't want to get into that now. But as far as technical trading is concerned, when we look at technical analysis, market structure accounts for almost 90% of your success in trading. So you need to understand the structure of the market, because the structure of the market is what will determine how far you can go for a buy, how far you can go for a sell, and so on and so on. We have different types of analysis as far as technical analysis is concerned, but market structure is key among all these things. We have supply and demand, we have technical support and resistance that we've looked at before, and then we have market structure, we have the trend, we have all these different structures of the market. But market structure is very important. Why? Because the direction or the trend is your friend. So low, lower high, lower low, lower high, lower low, lower high for selling or for bearish markets. So when the market is making such moves, then you need to position yourself with selling or shorting the market, or rather selling the market. And so that is an introduction to market structure. As far as market structure is concerned, where the direction of the market, we either moving up or we are moving down. But lastly now, but not least, let's look at the structure of the market, where the market is neither moving up nor moving down. And why does that happen? Why does that happen? So we want to look at that in short, and then we finish with it. So in this case, where we are now, the market from this point, let's circle it, from this point up to this point, the market is neither going up nor going down. Okay, it might not be a clear view, but in this case, really, the market is neither going up nor coming down, coming down, go up, come down, go up, like that, but within a certain box, within a certain bracket, or within a certain pocket, where it's not going above it and is not coming below it. So when the market is doing that, we say that the market is in a range. It is a ranging market. It is a ranging market. It is a consolidated market. It's in consolidation. It's neither going up above a certain line, it's not coming down below a certain line, it's just ranging, okay? It's moving up and down. It's in consolidation, or we call it a ranging market, or we also call it a sideways market. So three terminologies. So the market is neither moving up, uptrend, is neither coming down, downtrend, it's just ranging like that. We have three terminologies. Number one, we can say it's a sideways market, it's a ranging market, range, like ranging, okay? And then consolidated market, or it's in consolidation. It's neither moving up or down. And there are various reasons. One, some people might call it accumulation, that the market is accumulating, okay? Enough volume for enough orders for it to now pick up and buy or pick up and sell. It's an accumulation phase. Another reason could be that the big players are no longer in the market. Remember, they don't trade the markets 24 hours a day. They enter the market at certain points and they exit when they take profits. So with that, it means that chances are at this particular time, the market is ranging because the big players are not in the market to take the market to the heights of a buy trade, or to the market, to the direction of downtrend, where they are now selling to make the market move lower. So if that is what is happening, then that might cause the market to range. The market is in range. Okay, so that is basically what we have. And either another third reason is that the number of buyers and sellers, they are equal in the market. Remember, for the market to move up, it means that the buyers have to be more than the sellers. Not really in number, but the volume of money being traded in the direction of a buy direction. So if we have enough volume of buying force, then the market will be pushed higher. If we have enough volume for selling, okay, then the market will be drawn lower. So if the size of the buyers and the sellers in the market is equal, then the market will be ranging, because none is superior to the other, none is bigger than the other, none is heavier than the other. They are all the same weight, the same amount of money, the same liquidity. So the market will therefore be ranging. It will not go up. So we now understand why the market will range, or to be in consolidation, or it's in sideways. And if you're keen, then in that case, you should not, as a beginner, you should not trade the market at that time. Because remember, we wanted to know when to buy. When should you buy? In this case, when the market structure is upward, the market is going higher, you want to buy. When the market is going lower, you want to sell. When it's sideways, please, it's not the right time to trade. You need to step out of the market. Don't enter the market. Get out of the market if you're already in a trade. Exit the market, because that sideways move will take your time. It might end up taking your money that you've already generated as profit, and so on and so on. So you don't want to be in a ranging market as a beginner. There are those pro traders that know how to trade these, and that's okay. But as a beginner, you need to begin right. You don't want to trade the market that is ranging, it's in consolidation. You want to stay out of the market and you look for another market. Remember, with these, we're only looking at Euro USD, but we have different other markets, as you can see. Okay, on your charts, you can see on your screen, you can see AUD CAD, AUD CHF, AUD USD, Euro CAD. When one market is ranging, another is moving higher, or another is moving lower. So you don't need to say, now if I don't trade this and the market is ranging, what will I be trading? Find another market to trade, because the market structure is the same. Use the same analysis to make a decision to trade. What is good for Euro USD will also be good for CAD JPY, will also be good for GBP USD. So market structure is market structure. Whatever market is trending, that is what you should be trading. If it's sideways, consolidation, moving up and down, that way, leave the market and look for another market to trade. So those are the three concepts in market structure. Number one, it's a bullish market, or an upward move, or a buying market. Number two is a selling market, or downward trend, or bearish trend, where you should be looking for selling positions. Number three, a sideways market, which is also called consolidation, ranging market. That market you do not want to trade. You want to stay out of the market. So if that is clear, then now from here we'll pick up on where should you really enter the market, where should you exit the market. So today it was just a basic introduction to market structure, because out of this now you'll be able to know when to enter the market, when to exit, and where to take your profits, where to put your stop loss. This is very, very important. Market structure is everything that you need. 90% of the technical analysis is market structure. So with this, I think we can conclude the call today and call it a day, because this is enough. Now go to your charts, go to TradingView. It's open, it's free. Okay, look at the charts, look at any market. It could be an Apple stock market, it could be crypto, for example, BTC against the US dollar. Look at it. Where is the direction of the trend? Where can I trade this market? Where can I enter? Where can I stay out of the market? And so on and so on. Begin to notice a series of higher highs and higher lows. Next, on the next call, I'll be able to give you a tip of, without you drawing, how can you really look at the direction of the market without changing anything on your screen? How do you determine whether the market will go down or the market will go up? So finally, as a tip, that based on what you've learned today, therefore, it leaves you with one option to trade when you're following the trend. It's a tip that you do not predict the market. You react to the direction of the trend. You are either, if as a trader, you're either predicting or you are reacting. If you predict Remember, you're just a retail trader. You and I, we're retail traders. We can't predict. We can't predict with certainty that this is where the market will be going. Never forget that. So therefore, as a retail trader, you'd rather react. Wait for the trend to form and then react in the direction of the trend. That is a tip. And don't forget that. Now it's time for you to go to your charts and begin to notice where is the direction. Is it a ranging market? Is it an upward market? Is it a downward market? And all these, if you feel you're wasting time going through all these because by now you know where you can pick your trades and trading is becoming so much simpler and easier for you, then it's high time for you to get back to the academy, okay? Get the link. Get started with the academy. We have a $300 package that is highly recommended for you if you want to learn the in and outs of Forex. $300 only. And in addition to that, we'll give you a 90-day signal. Okay, signals for you to know when to buy, when to sell every day, every week for the next 90 days once you join our academy. That means that even if you're an existing trader, you can still benefit from our market structure, calls, weekly calls for the market outlook. You can get that as a benefit because we'll have a call for you to know what is the structure of the market this week before the week begins, so that you can get to know the key levels of the market where you can pick trades, or if you are a complete beginner, then you can benefit from the signals for the next 90 days. Just so you can pick the trades that we pick and win together and take the trades together. At times we lose, as already mentioned, but our winning rate is what determines our relevance in the market. So $300 package. If you want to take it a notch higher, then we have a $1,000 package that is given for you to, take this to a different level where you learn everything about Forex trading, where you can become a signal provider yourself and master the art of trading. If you're already a trader, this is good for you because you'll turn yourself into an institutional trader. $999. In addition to that, you'll learn everything about blockchain and cryptocurrencies. As I've already mentioned before, this is a market not to ignore. Crypto is a market not to ignore. A $2.9 trillion industry being traded every day. You can't ignore that. So you need the in and outs of that. The opportunities that come with this industry. So you learn everything about crypto, everything about blockchain, everything about social media, marketing and everything. Is just $999. In addition to that, you have access to our academy and every other tool that at your disposal. Remember, I mentioned before that we have something that can help you be able to know where the market will go as far as fundamentals are concerned and sentiment is concerned. We have our own tools that will be able to allow you to do that. So in addition to that, we have different other things, but let me not just, put everything in one pocket, but I highly recommend the $300 package because it will get you started and will get going. For the next 90 days, you'll be trading with us in our trading house, enjoying the signals. And thank you so much. That was the introduction to market structure. Thank you once again and welcome. Let's look out for the next call where we'll be going deeper on this lesson. I hope this has been very informative. Thank you so much. Remember to like our page, share these videos with your friends, give the link out there, let them also join us, and we'll be able to win together. Thank you so much, ladies and gentlemen. Once again, my name is Ben, and welcome to Premier Blockchain Hub, where skill meets opportunity. Thank you.